Hello traders, Gary Wagner here, just about 12:30 in Honolulu, 6:30 in New York. It is Wednesday, 13th day of May, 2020, and this is the daily report for gold and silver. A nice upside move in gold, a moderate move in silver, and a sell-off, hard sell-off in U.S. equities. On today's show, I want to cover really two basic points. The first one is the compression triangle that we have been looking at, and it has had an odd kind of an ending, and the question is whether we're witnessing any kind of a breakout, or is it possible that we'll continue to trade sideways because there was such a negligible move to the upside in the last day. The second thing I want to talk about, and I believe it's much more important because it has long-term implications, is the decoupling of the tandem move of gold and equities as they move to the upside in response to Federal Reserve quantitative easing. We'll discuss both of those topics in detail, but first, let's take a look at pricing. Traders, we are looking at gold pricing after Australia has opened. It is currently 12:08, so they've been open for about 8 minutes. Current pricing is 1723.10, up 670. Considering where the market opened up this morning, which is roughly at 1706, the price differential between 22 and 06 is the real move that we've experienced. On today's show, I want to talk about two things. First of all, the compression triangle and whether we're seeing some sort of a real breakout or not. And then secondly, the topic of the opening letter was that we're seeing a decoupling of the tandem upside moves that we've witnessed with gold and stocks that have occurred this occasion, as well as when the Fed intervened in 2008. When we look at spot, currently 17.15, 17.16. Platinum was down today, $774. Palladium also down 2%, 17.97. And then the Dow Industrial Average sold off, and it sold off pretty hard, down about 2% on the day. And lastly, silver, up 9 cents at $15.76.5. Let's take a look at our technical studies. As I spoke about in my opening letter today, it seems as though the relationship between gold and equities and the fact that they have been moving in tandem to the upside because of Federal Reserve intervention has in essence decoupled. We've seen it happen before, but what we're seeing now is the exact opposite effect. And I've put up this chart to kind of illustrate that. When we take a look, this is 2007 here. This is the beginning of the crisis. Of course, they really didn't do anything till about 2008 and started quantitative easing right around this area in 2009. This was what was called QE1. They added another round of QE2. Right around here, they did what was called twist QE3, and then they ended the program altogether. Now, here's what we saw. At the beginning, when intervention became the way the Fed was going to act to lessen the effects of the recession, we saw gold shoot up substantially. We saw equities shoot up substantially. Now, the slope, of course, was much steeper in gold than U.S. equities, but something interesting happened right around the middle of 2011. That's right here. And what that was is that we saw gold begin to trade lower, but we saw equities continue their historic rise up until the beginning of 2000 when it reached a new record high. That came in right here. The record high in gold is here. And that's what I mean by a decoupling, because here we're seeing gold continue to gain ground and we're seeing equities coming under major pressure. That is the exact opposite of what we saw back when we saw gold trade to 1900 and equities have their dramatic rise. A fall in gold, a continuation of the rally. What is most interesting to me is that if this is the beginning of a trend, we should see gold move dramatically higher if, in fact, U.S. equities continue to trade under pressure. That would be extremely bullish for gold, and it would really mitigate a challenge of the highs at 1800, and I believe eventually taking out 1920, the all-time record high. And traders, the next chart that I do want to look at is a daily candlestick chart in which we have highlighted a series of lower highs. Those are coming in right here, as well as a series of higher lows. That is the definition of a compression triangle. Now, if you see how they marked the close today, you can see that the green or real body doesn't trade above it. However, currently we're at 22, which is above the apex of the compression triangle. What I find quite fascinating is the fact that typically when we see this kind of a breakout, it releases energy, and what we get is really a strong candle to the upside. It would look something like this, and we're not getting that. That tells me there is the real potential that the market could in fact trade sideways to higher rather than a sharp breakout to the upside. But there's an incredible caveat to that, and that is if we continue to see U.S. equities trade under pressure and go into a deep correction, I believe we will see gold first challenge 1800, and that is not that far away when we look at it, and inevitably take out 1920, the all-time record high. If we get a solid opening tomorrow, we will issue a buy signal. We'll send that out by SMS text message. If you haven't signed up for that yet, it is free, but go ahead and sign up for it. You have to put your number in. We send you a code. When you click on the link and put the code in, it will then enable you to get everything via telephone that you would get by email. I really suggest you do both. In other words, the email is automatic, set up the SMS. But as I said, if we get follow through in the next 24 hours, we will initiate a long position. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.